Welcome friends for our Ind AS Knowledge Series video number 25. Today we are actually reaching two milestones. One, we are on the 25th video of our series. Second, we are going to cover with this Ind AS 41 all the equivalent Ind AS standards to the IAS series standards. In other words, what we are supposed to cover is the IFRS series standards and to their equivalent as per Ind AS, which will be starting from Ind AS 101 and it will go up to Ind AS 116. So today we cover the IAS series equivalent standards in Ind AS. Ind AS 41 agriculture is industry specific standard and also deals with certain specific aspects of how an industry which is engaged in agricultural activity or in dealing with biological assets has to be considered. In fact, majority of the people are thinking the standard should have been made or named as biological asset rather than agriculture, because majority of the activities is talking about the biological assets. And in this standard, to understand, I put it in a very simple manner. The biological assets has to be classified into two categories. Specifically, the categories are not spelled out as two separate classification. But if you read the standard right from the beginning to the end, these items are coming in. One, bearer biological asset, and another is consumable biological asset. Bearer biological asset could be a living plant or it's an animal. If it is an animal, that is covered under Ind AS 41, where it is a living plant which is a bearer biological asset, that will get covered under Ind AS 16 property, plant and equipment. That's the only thing. Otherwise, this standard is so simple. And why people are worried about this particular standard is it says at every point of time the biological asset has to be fair valued and the fair value changes has to be taken into the profit and loss account. So even if you are not realized, you are supposed to ensure that what is the fair value of the items and take the difference between the previous fair value and the current fair value to the profit and loss account is one of the issue which we are trying to cover under this particular standard. That is the reason why this standard underwent 3 times revision. Right from the day it has been introduced in India, it went for so much of revisions and final version is more or less equivalent to what is the standard adopted in Singapore for agricultural operations. Let's go into the standard. Before going into the standard, the usual request is that if you have any questions, any clarification you are seeking for, please post it in our channel itself so that I will answer in the channel to reach the larger audience per se. With that, let us go into the structure of our discussion. What is scoped in under this standard and what is scoped out of the standard is the first discussion. We should understand which standard should be applied will automatically comes as the answer from this particular scope in and scope out. The second is what are all the key definitions which we have to consider. And because of the key definition, what is the accounting treatment, recognition, measurement, disclosure, what are all the treatments which we have to consider is the next important point for our discussion. Bearer plants, as I have said, is outside the scope of Ind AS 41. It is actually dealt with as per Ind AS 16, property, plant and equipment, as per cost model, no revaluation model, as per the cost model prescribed under Ind AS 16, property, plant and equipment, the bearer plants has to be taken into consideration. The recognition principle, measurement principles, presentation and disclosure, all are covered as per the cost model of Ind AS 16, property, plant and equipment. Now, what is the recognition criteria with respect to a biological asset? We will see into that. What do you mean by biological asset? What do you mean by agricultural produce? All those things we will see. What do you mean by agricultural activity? So what is the measurement principle? Normally it measures at fair value. We will go into that in detail to understand what exactly we are talking about in this particular standard. What is the fair value methods which has to be adopted? What is the fair value hierarchy which we have to apply should also be understood. What you will do with the gain or loss on fair valuation of a biological asset, how it should be treated, whether it will be added to the cost of the asset or it should be charged to the P&L account. The standard says it should be charged to the P&L account as expenditure in case if there is a loss on fair value changes, or credited to the P&L account as a gain in case of fair value gain. So that is one of the important aspect. So far, whenever an asset has been revalued or fair valued, we never take it to the P&L account. Only in this standard, it prescribes that we have to take it to the profit and loss account. That becomes the biggest criticism for this particular standard. Treatment of government grant which is relating to biological asset or agricultural operation should also part of our discussion. So that will also be considered as part of our discussion here. And of course, we have what is the major disclosures to be considered under this particular standard. This standard is only a 13-page standard, but the industry like plantation industry, coffee plantation, tea plantation, rubber plantation, most of them are operating in corporate sector in India. They have come out with a critical comment when the standard came as a draft, because they felt that the agricultural activity is not within the control of the entity. It is decided by nature, and all of a sudden there will be higher fluctuations in the value of an asset. And if I'm taking to the profit and loss account and crediting to my profit and loss account, that will have a biggest impact at every quarter. And moreover, agricultural may be a seasonal activity. For example, the coffee plantation is a seasonal activity, whereas tea can be produced during the entire period. So when coffee plantation is having a different type of issues, tea plantation will have a different type of issue. So they are having a literal question about whether this particular standard is to be introduced in India. But the standard has been introduced, that standard has been applied, the standard has been practically applied by majority of the plantation companies who are in the listed category. Okay, with that, let's go into the standard. What is scoped out, scoped in is any transaction when they are relating to an agricultural activity, and that agricultural activity should be relating to a biological asset. When I'm saying biological asset, it relates to consumable biological asset or bearer biological asset. Let's see with some example what is consumable biological asset. Suppose if I grow a particular plant or grow a particular animal and I'm consuming it when it is matured and it is no more available, it has a fixed economic useful life and it is consumed at the end of the maturity. So that is called a consumable biological asset. What is bearer biological asset? It is a plant or anything which we can consider as an animal also, but it produces a lot of outputs or agricultural produce. That agricultural produce is actually sold, whereas the biological asset stands as it is as an asset. It is not consumed at the end of the economic useful life. Most likely at the end of the economic useful life, it might have been sold as a scrap. Those items are considered as bearer biological asset. Example could be coffee plantation, tea plantation, rubber trees, or even cattle or poultry, where we are talking about parent, grandparent, and grand-grandparent. So if you are in that particular industry, you will understand this particular situation. So biological asset could be consumable or it may be bearer biological asset. And it also talks about agricultural produce at the time of harvest. For example, I am plucking the tea leaves from out of the tea bushes. At the time of harvest, how I have to recognize and what is the value to be given for that agricultural produce is also covered by this particular standard. And of course, any government grant relating to agricultural activity is outside the scope of Ind AS 20 and it should be considered only as per this particular standard Ind AS 41. So now we are clear what is scoped in. What is scoped out? It does not apply for land relating to agricultural activity. So if there is a land, that land still continues to be under property plant equipment. That is not part of your biological asset. Biological asset is what is growing on the land which is used for agricultural activity and not considered, the land per se it's not considered as a biological asset. The land is a property plant and equipment. When I'm saying agricultural produce after the harvest, up to the time it is there in the biological asset or the bearer plant, it is considered as part of the biological asset. The moment it's plucked out, for example, tea leaves are taken out or the coffee beans or coffee fruits are plucked out, that becomes an agricultural produce after the harvest. The moment it's harvested, then it says that your applicability of this standard stops at that level and you have to apply the principles of Ind AS 2 inventories for valuing those agricultural produce after the harvest. At the point of the harvest, the standard covers them. When it is there in the plant also, the standard covers. But after it has been harvested, this standard is not applicable to those agricultural produce. It goes to Ind AS 2 inventory. Intangible assets which are related to agricultural activity. For example, I have entered into a lease for carrying out an agricultural operations on a leased land. Whether the leasehold rights is per se is a biological asset or covered by Ind AS 41? No, it is not covered. It again goes to intangible asset standard because of it doesn't have a physical substance. Bearer plants which are related to agricultural activity. When I am saying bearer plants, coffee plantation, tea plantation, rubber trees, they are plants which are bearing the agricultural produce and harvested item is coming out of the bearer plants, but these plants are having a life of more than 1 year or it may be even having more than 100 years, 200 years. For example, some of the tea bushes are having more than 100 years of life. Still they are producing the agricultural produce, tea leaves. So those bearer plants are outside the purview of Ind AS 41. What do you mean by the bearer plant? The bearer plant means the tea bushes, the coffee plants, the rubber trees. What is coming out of that is the tea leaves, which is an agricultural produce. What is coming out of the coffee plant? Coffee plant is a bearer plant. What is agricultural produce arising out of that is the coffee fruits. What is bearer plant? It's a rubber tree. What is the agricultural produce which the bearer plant gives is the latex. So you have to have a differentiation between what is a bearer plant and what is a consumable plant. Consumable plants are covered under Ind AS 41, whereas bearer plants are not covered under Ind AS 41. It should be accounted as per Ind AS 16 in cost model. Revaluation model is not permitted. Cost model which you have to apply for the tea bushes, rubber trees, whatever you are talking about. And when we are talking about palm trees, the palm trees will be bearer plants and the palms which you are harvesting from that is the agricultural produce. Similarly, any government grant which is related to bearer plants has to move out and go to, yes, in your Ind AS 16 read with Ind AS 20. Ind AS 16 is property plant equipment. Because the bearer plants are moving to Ind AS 16, to that extent the related government grant will also be under Ind AS 20 and not under Ind AS 41. Similarly, I have taken a land on a lease and that lease is a right of use of the land for a longer period as a lessee. that is also not covered. And of course, since the right of use asset is coming as a separate one under Ind AS 116, we should also check what is the other examples which we can give. For example, I am taking a know-how where the plants will be giving more outputs. So that technical know-how which I am taking it for my agricultural activity could be part of my intangible asset relating to agricultural activity, but that is not covered under this particular standard. It goes to Ind AS 38 intangible assets. So after we have seen what is scoped in, what is scoped out, very simply we can say what is covered in this standard is only those biological assets which are consumable biological assets. Those plants which are consumable plants. Those biological assets, if they are bearer plants, are outside the purview of this particular standard. Very simple understanding which we can have. Let us understand biological asset. Let us understand what is agricultural produce. Biological asset means a living animal or a plant. When I am saying living animal, it can be a cattle, it can be a poultry, it can be even a pig farm, whatever is a living animal, or it is a plant. Plant example which we can give, whatever we have seen, coffee plant, tea bushes, rubber trees, palm trees, all of them, even cotton uh, trees can also be considered as part of your plant. So it may be a living animal or it may be a plant. What is agricultural activity? This is important. Uh, Let me take that example immediately after this. What it says is that it is a management of a biological transformation. Very important point which you have to see. And out of which you are harvesting the biological assets for sale or for conversion into an agricultural produce or into any other biological asset. So let us take this on a keywords. What it says, management by an active entity of the biological transformation. It is very important because I have a forest, there automatically plants are growing, no management of biological transformation is happening. That means I am not putting any manure, I am not doing any irrigation, automatically it grows, and I am felling the trees. Whether that is covered as a biological asset, because it says anything relating to agricultural activity should be covered, and agricultural activity has been defined as management by an entity of a biological transformation. The biological transformation should be managed by the entity. If it is not managed by the entity, then it is not covered under this particular standard. So accordingly, forest trees are not covered, right, which are growing on its own. But if the forests have been managed by the entity and biological transformations are controlled to ensure that the trees are not infected, the trees are growing well, and whatever you wanted to have, you are doing irrigation, pesticides are applied, and whatever way, weeding, and whatever agricultural activity which you are doing, but it's a managed process of biological transformation. When the biological transformation happens on its own, it is not covered under this standard. So that is the reason why I gave an example of a forest tree is not a biological asset, even though it is a living plant, right? Then, out of this agricultural activity, I should be able to harvest the biological asset, and the biological assets are either used for my own sale, straight away it's sold, or it is converted into an agricultural produce. For example, when I am saying I uh, pluck the tea leaves, which is for sale as a green tea leaves without any process. So in that case, it is biological asset which is harvested for sale. But majority of the entities are not selling the green tea leaves. Instead, what they do is they process the tea. Even if you are calling as a green tea which you are taking, there is a process which is undergoing from the tea leaves which has been plucked out of the tea bushes. That process agriculture becomes a after processing, that becomes an agricultural produce, or it may be converted into another biological asset. So management of the biological transformation is important. Harvesting of the biological asset for own use or sale or for manufacturing and agricultural produce is an important aspect which we have to consider. If this is not there, even if there is a biological asset, the standard will not apply. Now, what do you mean by agricultural produce, which is harvested product of the entity's biological asset, which we have seen examples. Maybe we can have some sort of questions to understand. For example, the company has a grape wine yard, or it has a grape wine estates, and it harvests the grapes and produces that into a wine, converts that into a wine. It manufactures wine using its own uh, harvested agricultural produce of grapes from out of its grape vines. Now, which of these activities are in the scope of Ind AS 41 if you ask? First thing is, grape vines is a living plant, so it is a biological asset, but it is a bearer biological asset. It is not consumed. The grape vines itself is not consumed. It is capable of generating the agricultural produce over a cycle. So it has more than one cycle of production. So this is a bearer plant, and that plant should be accounted as per cost model in Ind AS 16. Goes out of the purview of Ind AS 41. Harvesting the grapes, where I am harvesting at the point of harvest or up to the point of time it is still there in the grape vines. What is growing? What is the agricultural transformation is happening based on management of the biological transformation? That is considered as an agricultural produce that is covered under Ind AS 41. What happens for the agricultural produce? We are plucking out the agricultural produce. So after the harvest, we said it has to move to Ind AS 2. When we are producing wine, whatever I have plucked out, is becoming the raw material for the wine production, and that is covered right from the raw material stage to the finished goods stage as per Ind AS 2. So for the same biological asset, different standards may be applicable. So you have to be careful to see what is the actual item which you are dealing with. Is this a bearer plant, or is an agricultural produce, or the agricultural produce after the harvest is used for your normal manufacturing activity? So based on which it goes to a different standard. Let us take some example for us to understand this concept clear. If you understood this concept, then the accounting is very simple. What is biological asset? What is the agricultural produce arising out of the biological asset? And what is the products as a result of processing the agricultural produce? This is exactly what the standard is talking about. So biological asset will be covered as per Ind AS 41, provided it's a consumable biological asset. If it is bearer biological asset, moves to Ind AS 16. Agricultural produce at the time of harvest and up to the stage where it is there in the bearer biological asset is covered under the standard. After harvest, it goes to Ind AS 2. Using that agricultural produce, I am doing a processing, then it will start going into Ind AS 2 as work in progress or finished goods. So that is the way in which we have to understand the arrangement of the standards for the particular process of agricultural activity. Suppose if I am taking sheep. Sheep is a biological asset because it's a living animal. Agricultural produce is the wool which I am harvesting from the sheep. But the sheep has more than one economic useful life. Every time I am not killing the sheep, whereas I am only taking the wool. Suppose if I am saying, no, it is not wool which I am producing. I am having this coats, COATS, codes, which I am actually biological transformation is managed by me over a period of time, and after that it is sold or it is sold, there is no scrap value, it doesn't produce any output. So in that case, that will become a living plant, but it's a consumable biological asset. In certain industries like a poultry, so where I will give that example, then you will understand. When you are having what we call the chicken, which we are using for consumption, those chicken are considered as biological asset, but it's a consumable biological asset. Living plant or living animal. It's a living animal. Don't argue with me, sir. It's a bird. How it's an animal? But animal includes birds. That's what the standard says. So you are considering that particular item, but it's consumed. The moment it's consumed, it is considered as part of the biological asset. Whereas if that particular bird is used for only laying of eggs, so in that case, what happens? Agricultural produces the eggs, but the biological asset is the hen. So that hen or the chicks has to be considered as biological asset. Then that is not a consumable biological asset, it is a bearer biological asset. Then the accounting treatment goes in a different perspective. So in a sheep, wool is the agricultural produce, the yarn or carpet which the company processes becomes the products. Suppose if the entity is not processing, but it simply sells the wool, then it is used for the agricultural activity has been done under a managed biological transformation for harvesting the agricultural produce for sale. It stops at that level. Further processing to convert into another agricultural product, then yarn or carpet comes in. Now you put it in tree near timber plantation. What do you mean by timber plantation? I grow the timber trees and they will be felled after they have matured. When they are felled, what is the product which we are having? It's the logs or lumbars or whatever sliced item you are having from out of the felled trees. But in this case, the trees are felled for the purposes of getting logs and lumbars. To that extent, it is considered as a living plant which is consumable biological asset, will be under this particular standard. Whereas rubber trees, where we are growing the biological asset, rubber trees are going to give what is the agricultural produce, latex. That latex is processed into rubber sheets, whatever you call. But what happens to the rubber trees? It has more than, say, for example, 25 years of useful life where it can generate or it can give the latex as the agricultural output by controlling or managing the biological transformation, properly irrigated, properly taken care of pesticides and other activity. So that case, it will be a bearer biological asset, whereas trees which are grown exclusively for the timber purposes, consumable biological asset. Cotton plants. Cotton plants are having the economic useful life. So it's a bearer biological asset, whereas harvested cotton is the agricultural produce. Thread and cloth which you are manufacturing out of that is a products arising out of it. Rubber tree I have already talked about is a bearer biological asset because you are only harvesting the latex from the rubber trees, and rubber trees are not sold as such. It may be scrapped after the economic useful life. So that scrap is not significant for our consideration. So it goes to Ind AS 16. So in simple terms, if it is a bearer biological asset, we will consider Ind AS 16 property, plant and equipment under cost model. All other items are considered under this particular standard Ind AS 41 agriculture. Another point which we have seen is that the agricultural produce which is growing in even bearer biological asset or in the consumable biological asset based on the management of the biological transformation should be under the purview of this standard. Up to what period? Till such time it's harvested. When harvested, it is the fair value of the harvested agricultural produce has to be determined, and and that becomes a deemed cost for the inventory. If it is processed further, that becomes the product that goes into inventory. That is the way in which you have to understand the implications of this particular standard. What do you mean by biological transformation? As I have said, it is a controlled process. If it is not a controlled process, it is not a biological transformation. The transformation happens in a tree. Tree grows from a small plant into a smaller tree and then a mature tree, and started giving the agricultural produce, or it is ready for felling it. But the process of transformation from a small sapling to a bigger tree is what we call it as a biological transformation. If that biological transformation has been controlled or managed by the entity, that is covered under Ind AS 41. If it is forest growth on its own, no management of the biological transformation, it is not covered under this standard. That's what I am repeating one more time. So what are all the processes which is taken care? Growth is considered. So increase in the quantity or improvement in the quantity of animal or plant. Okay, I have a parent in a poultry scenario. They used to say there is a case of the chicks which are consumed, and for taking the chicks you should have a parent, and the parent will have a grandparent. Sometimes great grandparents will also be there. Those are considered as fixed asset. They are not for consumption, so they are considered as bearer biological asset, because only you are harvesting out of them what is subsequently to be used. Okay, the eggs are taken and they are controlled to convert into chicks, and that chicks are consumable biological asset. If it is layers, then the layers itself, that chicks which are laying the eggs are considered as bearer biological asset, whereas the other items are considered as the consumable biological asset. Degeneration, decrease the quantity or deterioration because of the quantity. That is also a process which may happen. Production will happen, like latex, tea leaf, wool, milk, whatever. And procreation, these are all the processes of agriculture. Additional living animals or plants. So for example, in a poultry unit, we are talking about grandparents, and then parents are coming. Parents are giving the layers, or maybe consumable chickens which are being taken into consideration. So it is nothing but agricultural process which we are talking about. Let us have one quick question to understand. Suppose I am managing animal related recreational activity. For example, circus. I am managing the animal. I am training the animal. Whether it is considered as an agricultural activity? No, because that is a different business, and whatever you are having there is your property, plant and equipment, and to that extent it is not part of this particular standard. Ocean fishing is an agricultural activity? No, as I have said, when you are talking about the forest growth on its own, there is no managed activity of biological transformation. Similarly, fishing in the ocean is not an agricultural activity. I'm taking another twisted example. Suppose I am doing the fishing in fish farms created artificially, or maybe I am doing a shrimp culture in a controlled environment. Whether that will be covered under the standard? Yes, because the biological transformation is controlled or managed by the entity. So to that extent, it is an agricultural activity. So that will get covered, whereas ocean fishing activity is not an agricultural activity. Fish farming, definitely, it is a controlled activity, forming part of the standard. It raises the cattle, slaughters them at their and sells the carcasses to the local meat market. Is it under the scope of Ind AS 41? It is under the Ind AS 41. Whatever meat and whatever the leather which you are taking out of that will be covered under Ind AS 2. It is an agricultural produce. Even though it is a living animal, it's still considered as part of the managed biological transformation. So it is getting covered. Now you are very clear. Management activity of the biological transformation is important to get that particular item covered under this particular standard. Again, you have to see whether it's a bearer or consumable. If it is bearer, go to Ind AS 16. If it is consumable, use this particular standard. Again, the subsect is agricultural produce growing in the plant are considered as biological asset till such time it is harvested. At the time of harvest, you are fair valuing it and taking it as deemed cost for inventory. Subsequently, it goes to Ind AS 2 inventory standard. We are very clear on this. Now, we will move on to what is a bearer plant. Bearer plant is a living plant used in the production or supply of agricultural produce, whatever. We have taken the example, expected to bear the produce for more than one period. For example, if I'm saying paddy or I'm saying maize, I'm talking about wheat, where it will be grown and they will be harvested. The agricultural produce is the paddy, whereas the paddy field is actually paddy plant is actually growing, out of which you get the actual produce, which is rice, paddy or wheat or whatever, and then you process it. You get rice or processed wheat or whatever, right? So expected to bear the produce for more than one period. In case of rice or wheat, it is only for one season within the year. So accordingly, they will be outside the purview of bearer plant, even though they are only bearing the produce, but for not more than one period, they are not considered. People technically argue with me whenever I make a presentation. Some of the companies are saying, what do you mean by how you will classify sugar cane? Whether the sugar cane is a living plant, which is bearer plant. What they argue is that after the sugar cane has been fully grown, it is cut, but a portion is still there in the land, and that will again give an output. One more time, the produce will come. So accordingly, they say that it is more than one period. So we will consider that as a bearer plant. It's an argument. But if you consider how many industries are there having a sugar cane farm, will be very limited, which will be applying Ind AS. But for our discussion, we will limit the discussions with respect to living plant or living plant, which are simple examples of coffee, tea, rubber, palm, etc. So remote likelihood is being sold as agricultural produce. That means the entire plant itself is not sold as an agricultural produce. In simple terms, what is happening is we accept scrap sales. As I have said, after the end of the economic useful life, the terminology which has been used by rubber plantation is the rubber tree is slaughtered. Like they are slaughtering an animal, they are slaughtering the rubber trees to get the balanced output of latex, and then it is sold maybe as a firewood or maybe for manufacturing of furnitures and other items. So to that extent, it is only sold as a scrap. Still, it is a living plant which is expected to produce latex for more than one period, and it is used in the production or supply of an agricultural produce which is latex. So in that case, it is called a bearer plant. Bearer plant is outside the scope of Ind AS 41, goes to Ind AS 16. Again, I am repeating as per the cost model. At the same time, whatever produce which is growing on the bearer plants is still a biological asset. So if it is not harvested, up to that point of time, it is considered as a biological asset. That's the reason why people used to say fair value measurement is still required till such time you are harvesting the coffee fruits. So it takes, say, for example, 6 months. Up to 6 months, you have to fair value the agricultural produce in the bearer plant and take the fair value changes to your P&L. At the time of harvest, see what is the value and what you have already considered, account it according to Ind AS 2. That is the way in which it has been dealt with. Let us take some example for us to understand. It's a walnut tree and they are harvesting walnuts. for the walnut tree by itself is having a valuable timber. When I'm felling the tree after it is not giving any more walnuts, I normally fell the tree. The moment I fell the tree, walnut tree is having a very high market for use in the furniture industry and for interiors and whatever you call. And to that extent, even though it is not scrap value, it has a higher value. So because of that, whether I have to treat the trees, walnut trees itself, as per Ind AS 16 or Ind AS 41. What is the intention of the management? Intention of the management is growing the walnut trees for the final lumber or the logs, or for the purpose of harvesting walnut, incidentally you have a higher residual value. So the intention is to have the walnuts, and to that extent the walnut trees would be within the scope of Ind AS 41. Only thing which we have to talk about is that we are because the value is very high, if the part of the objective is growing the trees only for getting the end timber, walnuts are harvested as an incidental activity. The intention goes for the timber. That means it's a consumable biological asset. In that case, it is covered under Ind AS 41. But what you are growing is only to harvest walnut, and your plant or the tree, when it is felled, also has a value. Then your intention is to do or harvest the agricultural produce, then it becomes a bearer plant and goes to Ind AS 16. So the fact and the intention for which it is grown has to be seen. Why we are talking about walnut plant? Because it has a value as a timber. That's the reason why we are talking this as a value. If you are talking about any other plant, it may not be having a higher value. For example, coffee bushes may not have a resale value at the end of its economic life. It may be simply used as a firewood in processing the coffee fruits itself to create the pulp. So they may be using it. So now we have understood what is the agricultural activity, what is the agricultural produce, what is the bearer plant, what is the consumable plant, what is a living animal, and what is covered under Ind AS 41. Consumable plants are covered. The biological assets which are living plant is covered here, and any produce in the bearer plant is also covered under this particular standard. What is the recognition which we have to do? What is the point at which we have to recognize? What we are talking about is an asset, right? The moment we are talking about an asset, we have to have all these conditions to be satisfied. So we should have control over the asset. We should have economic benefits, future economic benefits arising out of that. And of course, here it uses the fair value should be reliably measured. Why? Because the standard says the accounting should be based on the fair value of the agricultural produce, fair value of the plant. So cost model is a secondary situation. Very, very rarely it is used. So instead of using the word cost should be reliably measured, which we have applied for Ind AS 16, Ind AS 2, when we are talking about Ind AS 38 intangible assets, we have applied only cost. Here we are saying fair value or cost, which can be reliably measured. At that point of time, if all these conditions are satisfied, you will recognize the biological asset in the financial statement. Okay, it meets the recognition criteria. How I have to measure? Initial measurement, what we have to do? Cost. Interestingly, it is fair value less cost to sell. Completely a deviation from whatever we have learned for other assets under other standards. Here it is based on the fair value less cost to sell. The moment I have initially measured that as fair value less cost to sell, what happens to the subsequent measurement? Again, that is also fair valued. Initially assuming that I have fair valued at 100, now the subsequent measurement on the reporting date is 200. What happens to the increase in fair value of 100? From 100 to 200 it has gone. 100 rupees is the increase in fair value. What we have to do that should be accounted in the P&L account, not to OCI, not to revaluation reserve. That is the peculiar accounting principles of Ind AS 41. Only in case if you are saying fair value cannot be reliably measured, it allows you to use a cost model, less accumulated depreciation, less accumulated impairment loss. In fact, it says when you are doing a cost assessment, it says it can be applied only at the initial measurement, not on the subsequent measurement. We will look into that little later because the fair value is a driver in this particular standard. Agricultural produce which is harvested from biological asset, at the point of harvest, the fair value less cost to sell will be the value attributed to the agricultural produce. That becomes a deemed cost for Ind AS 2. This is what you have to consider. Now, subsequent measurement of the agricultural produce goes to Ind AS 2. In Ind AS 2, deemed cost is fair value at the time, fair value less cost to sell at the point of harvest. And what is our net realizable value? We know about Ind AS 2. Net realizable value is what is the selling price minus the cost to complete the sale. That will be considered as net realizable value. Whichever is lower is what should be considered, because that is coming out of Ind AS 2. Now, let us take some worked out example to understand the measurement. Then you will be able to. So let us look into the worked out example to understand this concept clear. I am taking an example of a sheep farm where the value of purchase is 5 lakhs and there is a transaction cost of 2%, so that the sheep was on the market price. Market price is 5 lakhs. So fair value less cost to sell is what I am supposed to recognize. Let us look into that. And second thing is, at the end of the period, subsequent measurement, the fair value has gone to 6 lakhs. There is a transaction cost of 2%. How to determine the fair value in respect of this particular item? What happens? Fair value less cost to sell on the date of purchase is 4,90,000, because 2% is the expenditure that should be recognized in the profit and loss account. So what I am supposed to recognize is 4,90,000, because I have paid 5 lakh rupees, out of which 4,90,000 is the fair value less cost to sell, which should be recognized on the date of initial recognition. So I take only 4,90,000 rupees as the value of the biological asset. But I have paid 5 lakh rupees. What happens? On the date of initial recognition, there is a loss that should be debited to the P&L account straight away. Something unusual, because we are not doing a cost accounting, we are doing a fair value accounting, and that fair value is also fair value less cost to sell. So 5 lakhs is the price I have paid, but actually that incurs a transaction cost of 2%. Then only that becomes a fair value less cost to sell. Fair value is 5 lakhs, but fair value less cost to sell is what I am supposed to recognize. So it becomes 4,90,000. 10,000 is an expenditure to be charged in the P&L account. You can ask whether I can add it to the cost because it's an asset, directly a cost incurred for that particular item. No, it is a cost to be incurred for selling the asset, right? Cost to sell. Cost to sell cannot increase the value of the asset. That is the reason why we are charging to the P&L account. Now, we go to the end of the reporting period. That is a subsequent measurement where the fair value has gone to 6 lakh rupees. What is the cost to sell? 2%. After that, what is the fair value less cost to sell is 5.88. What is the initial fair value which I have considered? 4.90. So 5.88 minus 4.90, 0.98 is the gain or increase in the fair value. That fair value change should be credited to the profit and loss account. Journal entry will be biological asset debit because asset value goes up, and credit to P&L account as an income. So this is unusual. Whereas if it is a property, plant, equipment, what we will do, if we use the revaluation model, this will go to OCI or revaluation reserve, whatever we talk about. It is not going to the P&L account. But agricultural items, biological assets, when you are doing a fair valuation, the difference between the original fair valuation minus subsequent measurement, either gain or loss, will go to the P&L account. Clear? Now, let's go to the second situation. I take one more example for you to understand the concept, whatever we are talking about, so that you will be familiar with this. Here we are talking about, again, I have taken the similar example, only difference is there are some catch in this example. There we have been told what is the fair value, right? But here they are giving what is the fair value per cattle. And they have told what is the initial number of cattle. And what is the fair value of the entire cattle. They are not given what is the fair value of one single cattle at the initial measurement. Fair value less cost to sell, they are not given. In this example, we are assuming that there is no cost to sell. So fair value will be fair value less cost to sell. So how in this case we will determine the fair value and what is the change which has to be taken to the P&L account. What I am trying to do is that at the initial measurement, the fair value recognized is 13,750 and the 13,750 is for 250 items. So per item is 13,750 divided by 250. That is your fair value less cost to sell, because cost to sell is not there. We consider that as a fair value less cost to sell. Subsequent measurement, what it says is that the fair value of 3-year cattle is 60 rupees. The fair value of 4-year cattle is 75 rupees. How you will recognize on 31st March 2012. So in this case, what I am trying to do is that there is two changes which are happening. One, because of the change in the average price of cattle, there is a movement. And because the physical change or biological transformation is happening, out of that also there is a change which is happening on the fair value. So I have to calculate what is the change in the price and what is the change in physical biological transformation. So what I am trying to do is, initial fair value is 13,750 divided by number of cattle. I have 55 is the average price per cattle or average fair value per cattle. New price for the existing cattle or the new fair value for the existing cattle is 60 rupees. That is on the 3rd year. I will tell you why I am not taking 4th year. Because the 4th year is because from 3rd year to 4th year there is 1 year biological transformation. That is not price change. It is a biological transformation. I wanted to calculate separately. That is a simple reason. You can try to do that. But since the independent values are not given in this problem, we are trying to find out what is the price change, what is the transformation change. So 5 rupees per cattle, there is a change. So 250 numbers into 5,250 is the fair value change because of the price. Physical change from 3rd year to 4th year, 1 year growth is there. Because of that, the value changes. Instead of 60 rupees, it becomes 75 rupees. That is only attributable to the physical change of the cattle. So 75 is the 4th year, that is a year end. 3rd year is 60 rupees. What is the fair value or what is the increase in fair value due to physical change is 15 rupees. So 250 cattle into 15 rupees is arising out of physical change. And for us, the total increase is both price change as well as the physical change, which is the impact on the fair value change. 1,250 plus 3,750 is 5,000. What is the initial fair value? That is 13,750. So what is the closing fair value? Opening fair value plus whatever is the increase in fair value becomes 18,750. So what goes to the P&L account? 18,750 is the closing one. 13,750 is the opening one. The difference between these two, 5,000, will go to the P&L account as a credit. So what is the journal entry? Debit biological asset, credit gain on fair value changes of biological asset, 5,000 rupees. So now you understood what is happening as a fair value changes and how it is treated in the P&L account, in the financial statement. credited to the P&L account and debited to the biological asset. Now, what is a fair value measurement which we are talking about? It simply says fair value hierarchy will be as per Ind AS 113. So 113 says if there is an active market, take the active market price less cost to sell, because it's a fair value less cost to sell for the purposes of initial measurement as well as subsequent measurement. Suppose if I'm saying no, it is not relating to an active market, there is an identical asset, then you take the market price for a similar asset, adjust for the entity value, that we call this a level 2 adjustment. Take that. Suppose both this is not possible because it is a unique nature of the particular item, normally will not be the case, then you go for valuation techniques, that is a level 3 inputs. So that is coming under Ind AS 113, but we will discuss that at length when we are discussing Ind AS 113 fair value measurement. That's what it says. If you are having separate market price, take the fair value, or otherwise you adjust it for identical assets. Suppose if the biological assets are not having a separate valuation, for example, sometimes a market is available only for the land plus what is available on the land, then only you have the market. Then what you have to do is first take the consolidated value of land plus the biological asset which is standing on the land, and then find out what is the fair value of the land. The difference between these two is considered as a fair value of the biological asset. So indirect way of considering that if there is no active market, where the consolidated value is there, determine the consolidated value, eliminate the value of the land by separate valuation, find out or a derived value of the biological assets fair value is taken into consideration. So what we are trying to identify is what is the price change, what is the physical change. Both are considered as a fair value changes. One important point is that the rebuttable presumption is fair value can be measured for a biological asset always reliably. So that means you cannot say, sorry, I could not relate the biological asset. This is the way in which the industries are trying to say, but it has been negated by ASB. This is negated by the Ministry of Corporate Affairs, and they have said it is a rebuttable presumption. You have to say why. Very difficult to prove. So valuation techniques has to be applied in case if you are not having an active market. That is an important aspect for fair value measurement on this. So let us understand the fair value hierarchy. What it says that history of large variations in the outcome. So all of a sudden fair value goes up, all of a sudden the value comes down because of the biological transformation. And accordingly, management says fair value measurement is impracticable. Can I use the cost model? No, it should be measured at fair value less cost to sell only according to this standard. An entity grows consumable assets with a very long production cycle, and there is no forward market price available. Can it measure at cost? No. There also it says you have to value at fair value less cost to sell. You have to determine what is the price based on valuation technique. That is exactly what comes in this. Let's take one more example. They have entered into a forward contract or a future contract at a predetermined contract price, and the entity wanted to use the contracted price as the fair value less cost to sell. Is it possible? The standard says no. A fair value is different because fair value is arising between market participant at a normal transaction. Whereas when you are saying a contracted or future consideration, the contracted price may not be equivalent to the fair value. So you have to test whether the fair value is there. You cannot simply say that my risk is limited to only the contracted price, I will do the fair valuation. No, it is not permitted. Entity wanted to do the fair valuation not for individual biological asset, but grouping the biological asset. Maybe, for example, they say that any plant which is having 5 years of age, or any plant which manufactures A grade of agricultural produce, we wanted to group them. Others are the various category, 10 years, 15 years category. Is it possible, and can we determine for the group fair value less cost to sell? The standard as a practical expedient allows this to be done. If it is a meaningful measurement, it says you can do this particular situation. Now, one exception where it says the cost could be approximate fair value. That it also checks in certain scenarios. Where it is possible, it says the biological transformations are very, very little. So nothing is big biological transformation. Now only I put the seed, nothing has grown even as a sapling. So if I am doing a fair valuation, nothing is going to come as a fair valuation. So to that extent, little biological transformation has happened and the cost is equivalent to the fair value. If at all somebody wanted to take the sapling, what they will say, so this is your cost and this is the price at which I will also wanted to say. It approximates, cost approximates the fair value. Newly acquired livestock, because I very recently purchased chicks. In that case, it's a transaction value is more or less equivalent to the fair value. Sometimes the transformation on the price is not expected to be material. Transformation happens, but the price is not going to increase significantly. For example, it is a 30-year pine plantation and initial growth for the first 5 years or 6 years, it doesn't have any value. Maybe 10 years, it doesn't have any value. So if the price changes are not going to be significant based on the biological growth, then cost approximates the fair value. That is the reason why it says that you can substitute the cost to the fair valuation at the initial measurement if the cost approximates the fair value. Otherwise, you should always have fair value less cost to sell. Another possible question is, I am unable to measure the fair value. What I have to do with that? If I am saying that I am unable to measure the fair value, what I am supposed to do is that it says the quoted market price is not available, alternative fair value measurement is clearly unreliable. In that case, you can do at cost less accumulated depreciation and any accumulated impairment loss. But this is very, very clearly said. You can apply the presumption that I am unable to measure the fair value only at the time of initial recognition. But subsequent to that, there is a biological transformation happens, the biological assets are matured, and to that extent there is an active market will be available. So you have to go for that fair valuation in the subsequent measurement if there is a reliable measurement is available. So on the date, this presumption fails and you have to go for a fair valuation of that particular biological asset and take that credit to the P&L account. Suppose if there is a change in valuation assumptions, may revise the valuation assumptions. In that case, whether the change in valuation assumption should be applied on a retrospective basis, no, it is a change in estimate, and accordingly, we have to consider that only as a prospective adjustment. No restatement of the previously reported number is required. Only current year adjustment will be done on a prospective basis, being a change in estimate. But if there is an error in the previous year in making that estimate, if you recollect Ind AS 8, it says that any change, any accounting for an errors of the prior period should be a restatement of the periods, prior periods as well. So except in that case, it will be on a prospective basis read with Ind AS 8. What to do with the gain or losses? If it is a biological asset, gain or losses on initial recognition could be possible. What we have seen, 5 lakh, but there is a 2% cost to complete that, fair value less cost to sell, 10,000 is the loss on initial recognition, which may happen, or based on the reporting period, subsequent measurement, the changes in fair value may happen. Suppose gain on loss on initial recognition because of the transaction cost which you have seen, maybe a gain will start because a new calf has been born at the time of initial recognition itself. You don't have a cost, but you have a biological asset. Similarly, change in fair value less cost to sell when it changes, the entire thing should go to P&L account in the period in which it arises. That means initial measurement, it goes to the initial measurement period. Subsequent measurement, go to the reporting period conclusion. Similarly, agricultural produce in the biological asset should also be fair valued, and the gain should be taken to P&L account. That's a simple concept. For agricultural produce in the plant or on the plant, and biological asset which has been acquired and there is a biological transformation which is happening. Let us take one example for us to understand this concept, maybe a worked out example which I can give it to you. So it says the file is not opened up. Maybe I will take it later when we are going to have some worked out examples at a later point of time. Now, let us take some example to understand, because we are not having the Excel spreadsheet. 2001 entity is having a cow that has given a birth to a calf. The fair value less estimated cost to sell the calf is 5,000. How and when it should be recognized? So initially I have paid something. The 5,000 should be immediately recognized in the statement of profit and loss account in the period in which the calf has been purchased. Okay, sorry, the calf has been born. We have to recognize, because it increases the fair value of the biological asset. So it should be immediately recognized. What it says, government grant for biological asset. Interesting point is, if the biological assets are measured at fair value less cost to sell, there are some conditions. If it is measured at cost, biological assets are measured at cost, what is the accounting treatment? So if the fair value less cost to sell is the basis in which my biological assets have been valued, and if the grant is conditional, only if the condition is met, we will recognize in the P&L account. When the grant is unconditional, if the entity believes that it's recoverable, it should be immediately recognized in the profit and loss account. There is no condition. Accordingly, you have to only look for whether it's receivable, recoverable. So in that case, you will recognize an asset and recognize the related gain in the profit and loss account. If it is fair value less cost to sell, is a measurement for the related biological asset. Suppose if it is measured, the biological asset is measured at cost, you will go to Ind AS 20. What happens to Ind AS 20? Ind AS 20 gives two options. One, you can set it off against the related asset, or you can set off as a deferred income. Both are permitted. You can think about it. The government grant may be a revenue grant. In that case, you will recognize in the P&L account when the conditions are met, or if it is receivable as per Ind AS 20. If it is a capital grant relating to a particular asset or group of asset, you can reduce from the carrying value of the asset, or you can set up a deferred income. Both options are available as per Ind AS 20. We have already discussed that. If you have a doubt, go back to our video on Ind AS 20 and recap whatever we have discussed on that. This is a treatment. But if you ask, what is the big deal? Only difference where we are considering here is, we normally considered only one aspect, whether it's a capital grant or a revenue grant, whether conditions are met or conditions are expected to be met. If it is relating to an asset, what is the accounting treatment? If it is a revenue grant, what is the accounting treatment? We stop at that level. We will not go with what is the related asset has been recognized, what is the basis. So fair value less cost to sell, I am not even going for a capital process. I am simply saying that if the conditions met, I will recognize. If it is unconditional, if it is receivable, I will recognize. And it is not getting adjusted in the carrying amount of the asset. It's set up as a deferred income. That is the biggest difference as per Ind AS 41 on agriculture when we are talking about government grant relating to biological asset. Here, huge plot of land offers a grant of 10 crore under the condition that the land is being cultivated for next 5 years. The land will be cultivated for a shorter period. The entity is required to return the grant. When the entity should recognize the government grant, will be recognized as an income only after 5 years of cultivation, because you are not sure whether the conditions will be met, and accordingly you are deferring and recognizing over this. There could be a valid argument which can be put forth where the entity, based on similar trend in the past, has continued to cultivate and conditions are met. So accordingly, we are saying that it's probable that the conditions will be met. I will recognize this. you can consider this as so, provided what is the fair value measurement which has been considered. If it is a fair value, it says conditions are met. If it is a conditional one, then only you can recognize. Conditions will be met only at the end of the 5 years period. There is an estimate the conditions will be met. So which is not actually the correct way of looking into that. Under this, if it is fair valued, less cost to sell in the case of biological asset. If it is a cost, then probability can be assessed. But an argument is, if it is put forth by an entity that the condition is expected to be met, lot of past trends are available, the argument can also be acceptable according to my view. What is the major disclosure? Because we have understood what is the items which are covered here, what is the way in which you have to do fair value less cost to sell. If it is a bearer plant, it goes to Ind AS 16 cost model. If the cost approximates the fair value, we can consider the fair value at the initial measurement only. Subsequent measurement where there is a maturity, we have to take that fair value as the deemed cost. And fair value changes has to be credited to the P&L account with a corresponding debit to the biological asset. We have seen everything. Now, what is the related disclosure? Major disclosures. Aggregate gain or loss which has been accounted in the current period, you have to show it as a separate line item even in the statement of profit and loss. What is the group of biological asset which you are determining the fair value? We have said that it's possible. What is the opening fair value of the biological asset and what is the closing value of the biological asset? What is the changes which has happened? Maybe there is a biological transformation, there is a price change. All those items you have to say. Maybe you have tested for impairment and because of that you have reduced a value. Everything will come into the picture. In simple terms, more or less it is a disclosure which we are doing for a property plant equipment. Only thing is here we are talking about a biological asset where this presentation is being done. In property plant equipment, it's a cost model, whereas here it is a fair value model. That's another point. Suppose if you are using a cost model, you have to disclose what is the accumulated depreciation, what is the additional disclosure, why fair value cannot be measured reliably. That is what it's requiring. Rebuttable presumption is fair value should be measured, and in case if it is not there, you have to say why it is not met. And existence and carrying amount of biological assets where the title is restricted, there is any restriction on the title, you have to disclose that. In case if the biological assets are pledged as a collateral for any liability, then you have to disclose that. In case if there is any commitment or contingent liabilities relating to biological asset on the development or acquisition, that should also be disclosed. Any financial risk related strategy which they are adopting, because the prices may fluctuate, fair values may be fluctuating, company may not have the control. What is the way in which they are assessing the risk and how they are mitigating the risk, maybe by means of some hedging activity or commodity pricing? Those related disclosure should also come as part of FRM disclosure in respect of the agricultural activity. Suppose if the fair value cannot be reliably measured, additional disclosures are also required. What is that additional disclosure? What is the description of an asset? Why it is not able to reliably measure it? And what is the range of the value? You remember that we have given this also in certain case. When we are saying what is the range? Range could be, say, from this range to this range, that could be a fair value. In investment property, we have discussed about that. When you are not able to have the fair value to be disclosed in respect of the investment property, you can give a value from 10 crore to 50 crore or 10 crore to 13 crore is the expected range of the fair value. You can give that also when you are taking into consideration. What is the depreciation method adopted? So when I'm saying that it's a bearer plant and goes into Ind AS 16 property plant equipment, you should depreciate according to Ind AS 16. What is the useful life estimate for the bearer plant? You have to explain. What is the gross carrying amount? What is the accumulated depreciation? What is the opening balance? What is the closing balance? What is the impairment which you have tested? Everything should also come into the major disclosure if you are adopting a cost basis, not a fair valuation basis. Because the standard first prescription is fair value less cost to sell. Only as an alternative where it is impracticable, they are giving this. and users should know that it is valued at cost. That is the reason why elaborate discussions or elaborate disclosures are being required in that particular situation. And normally we have one more slide, right? What is that slide? A comparison between Ind AS and AS. I don't have the slide. I'm straight away going to the question and answers for a simple reason. There is no equivalent standard in India as per IGAP. So accordingly, everything is different. So entire accounting treatment is a new set of accounting treatment which we have to learn, practice, and use. So we have seen the recognition principles, the measurement principles, the fair value principles, and the when you can substitute cost we have seen, and we have also seen what is the related disclosure which we have to see. The biological assets are classified into two categories: bearer biological asset and uh, consumable biological asset. Consumable biological assets are under this particular standard. Bearer biological assets are going to Ind AS 16 at cost model we have seen. And we have also seen what you mean by agricultural activity, which is a managed biological transformation. So then only the standard will be applied, otherwise it is not applied. So with all those things, with the disclosure, I'm pretty much sure that you have understood the implications of Ind AS 41 agriculture completely without any doubt. But still there could be a possible doubt, possible question, or possible clarification you are looking for to understand the concept little further. Please post your questions. Please post your comments. Please post your fact pattern for the clarification which you are looking for in our YouTube channel, so that I will be able to answer this for the benefit of our entire subscribers of our channel. With that, thank you for viewing this video, and the next video will be our 100 plus series, or otherwise equivalent Ind AS series for IFRS series standards, right? So we have reached a great milestone covering almost all the IAS series standards. That is the equivalent standard for IAS series IFRS standards we have covered. So it could be possible, or I might be able to do it only because of all the support and motivation, encouragement you people have given. Some of the comments which I'm getting is actually making me to feel highly emotional that there is a value addition coming out of my videos, and makes me to uh, have make an endeavor to make most advanced research and give more and more for the benefit of the viewers. Continue to give that encouragement, continue to motivate me, and we will see with an IFRS series equivalent Ind AS standards starting from the next video. What I'm planning is I will not post Ind AS 101 in the next video. I will start with Ind AS 102 for a simple reason. Ind AS 101 is for first time adoption of an Ind AS standard. So to that extent, the transition impact you have to understand. Only after going through that you will be able to understand all the standards. That's the reason why Ind AS 1 I am keeping it as a last standard to be covered. We will start from 102, which is talking about share-based payments, in the next video. And then 103, 104, 105, 106, 107, 108, 109, 110, 112, 111, 112, 113, 114, 115, important standard everybody is looking for, 116 on leases. We will look into that as well quickly. And of course, with that, I will take leave, and thank you very much. And stay home, stay safe. I will come back with another interesting video in our Ind AS Knowledge Series videos, maybe in a couple of days. Thank you.